Hello from day two of the Global Borrowers and Bond Investors Forum. We're joined by Shrey Kohli from the LSE. Shrey, in the context of weak global market for IPOs and for the London Stock Exchange in particular, what's the future of public equity markets?
So Jeremy, thank you for having me. I think no one in 2022 expected us to go through the shocks of war in Ukraine, inflation where it was, and the interest rate changes that followed. And obviously, global equity market valuations have taken its time to reflect the impact of that. And that's largely what we're seeing this year. I mean, I know you mentioned it's been particularly weak for London. The one thing that I would say is it's no weaker or better for London than it is for any global financial center in the world. And actually, in Europe, London continues to remain the largest equity exchange, both in terms of IPO capital raised, as well as follow-on issuance. And follow-on issuance being resilient at a point of time of global macro weakness is an indicator of the strength of latent demand within the market. And I think it's incredibly positive to see for global public markets is that there is still a pipeline and there's demand, particularly in London. Sustainable businesses or green equity businesses is a key area that we're spending time and focus on, along with the tech sector. And I think as the interest rate environment plays out, you're going to see a return to appetite, return to equity markets.
Yeah. And how will the UK listing regime for equities change? And what is the Capital Markets Industry Taskforce trying to achieve?
So I think it's a once-in-a-generation change that we're going through in the UK in terms of our regulatory framework. And it started with the Lord Hill review, which then made its way to the Edinburgh reforms. And to the extent that the Financial Conduct Authority in the UK had powers to make changes, they already have. And now what we're going through is a process which is called the Primary Markets Effectiveness Review. So we're looking at creating a level playing field for companies which are listed in UK markets from an equity perspective, and also make it comparable to global standards. But in addition to that, I think there's a conversation that we're now having about the concept of risk appetite and supporting growth capital. And when dividend yields are comparable to one-year gilt yields or government bond yields, I think growth is where investors will see real returns. And that's what the Capital Markets Industry Taskforce is about, which is chaired by the CEO of the London Stock Exchange, Julia Hoggett. It's about encouraging pension funds to support more growth companies. It's about the culture and discourse that we have about capital markets supporting jobs, innovation and growth in our country, which we tend not to have that discussion, and connecting it to the real economy, which is, I think, fundamental for the development of the UK, but as well as European capital markets in the future.
Yeah, absolutely. Global debt volumes this year are down 20%, and how has that impacted the LSE compared to anyone else, or specifically for London?
Yeah, so I think softer debt markets this year after strong Q1 has largely been due to the exogenous shock of the US banking crisis. I think no one expected Q2 to be the way it was, but yes, global debt markets are 20% down in terms of volume year on year. For the LSE, interestingly enough, we've seen debt capital raised on our markets up 50%. So it's $300 billion this year, May year to date, and $200 billion last year. And that's not just because of a few large transactions. There's a 40% increase in the number of transactions on our markets as well. And I think that's an indicator of the London regulatory structure and the offering that we have for our fixed income clients being something that global issuers like. So we've seen a breadth of issuers across the SSA, FIG, and corporate space, and across the world, right from Australia and New Zealand through to Chile, Mexico, and California. Access markets through our proposition this year. And I think the London Stock Exchange Group, with the G in focus, is also a very different place where it was a couple of years ago after its merger with Refinitiv. So now we can provide our issuers with a lot more data, analytics, and a global listing and trading platform for not just fixed income, for FX, for equity, which is highly relevant as a financial market infrastructure provider.
Absolutely. I mean, a huge benefit of the merger, right? And will any of the listings and prospectus changes impact bond markets? And if so, how?
So I think, Jeremy, it's important to acknowledge that bond markets and Eurobond markets are global in nature. Investors in Asia and the Middle East can buy corporate or supranational paper issued in Europe, in the US, in the UK, amongst other countries. And what we want to continue is an element of regulatory convergence which doesn't lead to fragmentation. I think fragmentation helps no one. But in that context, I think UK wholesale markets are performing really well, which I alluded to in your last question. And what we want to ensure is that regime continues to be simple, straightforward and effective, especially when market windows are getting incredibly narrow and execution certainty is important when bringing a transaction to market. So, for example, in the UK prospectus rules, sovereign and supranational issuers now have an exemption from approvals. We want that to extend to sukuks. Companies do a lot of disclosure through their equity disclosure. We want it to be incorporated by reference, especially for future financial information in their prospectuses. MTN documents can last for longer than a year, especially when updates are non-material. I think that will ensure that wholesale markets continue to be effective, but are generally coherent with the way global regimes work. But I think the key change in the UK is going to be on access to not just institutional investors, but private investors together with institutional capital. Because what the FCA is consulting on is a regime to allow UK equity issuers with a seasoned track record to be issuing in smaller denominations, largely based on their wholesale prospectuses, for bonds which are simple, vanilla, fixed rate or floating rate structures. I think that's really powerful because you and I may invest in the London Stock Exchange or Marks and Spencer's, but normally their bonds are issued in 100K denom and above. And debt, last time I checked, was higher on the default waterfall than equity. But that's going to be a massive change, and I think that's going to democratize fixed income markets in a way that we haven't seen before, and allow us, through perhaps our phones, to be able to buy bonds. At the same point in time, institutional investors are ensuring that the credit performs the way that it does, and we get the pricing that we want. So that's exciting in the prospectus rule changes.
Fantastic. Shrey, thank you so much for your time, and thanks for joining us, and we'll look forward to seeing you again next year, and
Always appreciate it, Jeremy.
Thank you.